Welcome back to this special edition of the Capitalist Investor. A lot of crazy things happening the past 2 days, man.
It's been busy.
We got to do special edition. When the market's up 4% like a day yesterday, the best this year, I think.
I think we're pretty unique, though. Crazy as Powell talked. I mean, like,
Powell's always
that's
chirping.
some kind of
He's
crazy,
always
I'm
chirping,
sure.
and no one ever knows what he's saying. No one. I think the market. That's kind of what I want to hit on a little bit. Is the market doesn't know how to interpret Powell. Like, Powell says a lot of things, but no one really knows what he says.
Well, it was good, right? Everyone was up 2 to 4% yesterday, and whatever inflection he used explaining what's going on in their brain, people liked it.
Well, let's hit on some of the things he talked about, right? So one of the things he mentioned that a lot of people got excited about is possibly pivoting or becoming more dovish.
Did you hear that, though? I mean, like, we do this. We listen to pretty much everything, and I didn't really sense too much dovish. It was more dovish than recently.
He said he's going to keep rates high and stay there longer. That, to me, is not dovish. But the market interpreted that way, that he got a little, optimistic about inflation coming down. Like, that was basically what they took as dovishness. But the reason why inflation's coming down, the reason why they're pausing, is to see how it impacts next year and whether or not we're going to get a recession.
Well, it doesn't matter for a lot of people, but if you've retired recently or you're planning on retiring, I mean, this could be one of the most significant obstacles that you could be facing. I mean, seek help, really. Change your strategy. If you're passive into this, it could be trouble. You might want to think about tactical investing. Sequence of returns risk is a serious issue for you, and you want to be tactical.
Explain sequence of return risk.
So sequence of returns risk just says, like, hey, a lot of times in planning, we account for like a 5 to 6 or 7% growth that changes over time, but how that growth occurs can matter. And so, like, if you lose 20% of your life savings in the first year after you've retired and you need to live off of that, that can greatly alter the next 2 decades of your life. So it's like, I'm not hoping for a recession, but it's kind of a good thing for us because assets come down and we can buy more with the same dollar, right?
Well, it's where the excess kind of gets depleted, right? We've lived in a lot of excess since 2008, 2009, ever since COVID pumped all the money. So a lot of excess needs to come out of the market. A lot of liquidity has come out of the market. It needs to continue to happen, right? To bring down inflation. Now, what I will say, I will counteract a little bit of what you said about the younger crowd. From an investing standpoint, you're absolutely right. However, that works all fine and dandy as long as people have jobs.
Right.
And one of the most important things, and one of the things that has to happen to bring inflation down from the Fed standpoint, is to continue to tighten the labor market, to get rid of all the excess in the labor market, to get rid of all the slack, it's called, right? So as long as you have a job, this should benefit a lot of younger folks that don't have their huge nest egg yet invested, right? As they're contributing to 401ks, whatever it be. But that works as long as you have a job. So make sure, just keep in mind that a lot of employees and a lot of the younger folks that have had the power over the past couple of years to switch jobs, to say, hey, I hate this job, I'm going to go over here and make, 25% more money. That's not going to happen over the next probably year and a half, 2 years even.
Unless you're a railroad worker.
I guess maybe, right?
Yeah.
But just keep that in mind as, you're approaching your employment, you're maybe not looking to leave, making sure you're trying to be stable. Just think about that going forward, because if you are still making money, still having cash flow, you aren't maybe living paycheck to paycheck. I know a lot of people are. That's another caveat. Inflation is very high. Make sure you are contributing in a down market to try dollar cost average in. But, if you are a retiree, you got to prepare for this kind of thing.
Yep. Yeah. Make sure you contact someone. So anyways, we'd be a great contact, by the way, too. But let's move on to the next thing. So Powell spoke. Now we had some data come in today, and it was kind of a mixed bag too, right? So the market, it responded well at first, but kind of when you look underneath the hood, I mean, some of those good numbers, looks like a little bit of government sloshing money around still, and so the income especially.
A lot of the numbers came out this morning, and Mark Tepper, was on Mornings with Maria talking about that. So let's play the clip.
I think you want to stick with quality companies, dividend payers. I think that's where you want to be. To your point, value. I mean, look, since 2008 and 9. You've wanted to be in growth because interest rates have been zero. That's no longer the case. You now want to make sure you're investing in good quality companies. And to Todd's point about holiday spending, Adobe's data is suggesting a 4% year-over-year increase just for Cyber Week alone. Now, that is up in nominal terms year over year, but down in real terms. And to Cheryl's point about the personal savings rate, I think being like 2.1%, I believe she said, that is near historic lows. And we are now in the like rob Peter to pay Paul point of this economic cycle, where in order for people to pull out their wallet and buy goods for this holiday, they're going to have to reach for their credit card. They're not going to be doing this from cash they have in their wallet. They're going to be using their credit cards. And we've seen credit card debt go up. We've seen credit card delinquencies and default rates go up. So, you know, typically when these things start to happen, it can be a little bit misleading while it's happening, but then we look back after the fact and we say, now I see what happened.
2.3%, to be clear, on the personal savings rate, but that's down from 2.4% the month prior. And I know that that's something that you've been watching month to month with this data.
So the savings rate has been coming down.
Yes.
Well,
one of the questions I got asked today on TV was about stimmy checks.
Yeah.
Like how states are giving out stimmy checks and just, you know, more inflationary pressures out there. Yeah,
Right.
Incomes went up, but yeah, inflation's rising at the
It was
same
a
pace.
big piece, you know, the wage growth's up, but a big piece of the personal income increase is state government money. So
Yeah.
is that sustainable? I think, you know, a lot of people know how we feel about that, but
It's insane. Government spending is inflationary. Government spending doesn't let the free markets operate properly, and it counteracts what the Federal Reserve's trying to do. So you got the federal government stimulating the economy. You got the Federal Reserve taking out liquidity. They're fighting two different battles. Or, you know, they're trying to fight the same battle, but they're doing it two different ways, and it's counteracting each other. That's one thing that's concerning about the future, is that it's all political bias. It's all political based. It's not financial based. You know, I think politicians need to start taking economics classes.
yeah. Well, it's been a while since we balanced a budget on a federal level, and there's no one even really shows a willingness. So the spending has just increased, and we'll keep on kicking the can. Thankfully, we have young people that have 5 decades to work, you know, and
Yeah,
we appreciate
I mean-
you. Thank you.
Well, the thing is, you call me young, bro,
Yeah.
but I got a long time. But that being said, a lot of people do, and you got to take advantage of these situations. So
Yep.
we just want to hit on a couple of those points there. You know, there's a lot of things, moving parts, moving pieces. You don't even know what kind of information to trust nowadays. That's why we do it for you. We take all the information, digest it, and come up with our own opinions about it. So we'll see you guys on the next special episode, or tune in to our Capitalist Investor. You can see it on Spotify, iTunes every single week.